What's up, everybody? My name is Garrett McIntyre. This is a first of hopefully many video series that we're going to be doing. Today, we're going to be focusing on multifamily underwriting. And I am lucky enough to have my partner on here, Jeff Guo. He is the Director of Analysis for RIZE Equity Group. And in my opinion, he's probably one of the smartest guys in the room. Every time he's in the room, he's very humble in his approach. I've learned so much from him already in underwriting, and me and Jeff kind of tackle underwriting together on some of our multifamily acquisitions. But he is the guy that I will lean on constantly. So Jeff, thanks for doing this today. And why don't you tell everybody just a little bit about yourself before we get started?
Yeah, absolutely. I'm glad to be here, Gary, and thanks for the opportunity. So my name is Jeff. I came from I love real estate ever since high school, and studied real estate finance in college. And the first job after college, very fortunate, worked for a mid-sized REIT based in Washington, D.C., does acquisition and asset management, help oversee a portfolio of commercial properties, about $350 to $400 million. Just learned a ton from industry veterans. Love the numbers, and love to look at assets from both a high level, super high level, 30,000 feet level, and also down to the 1 feet to see, if every number checks off. So excited to be here and kind of share a few sentences about underwriting and what we can do to add value to you guys.
Awesome. So just so the people, maybe some newbies, because we kind of try to give education for all levels. Some new people that are new to real estate, or people that have been doing it for a long time and are just looking to see how other people are doing things. He talks about high level. He's talking about just a really big, broad look at things. So real quick, back of the napkin look, fast analysis. And then when we see something that catches our eyes, then we really get into the details. Then we look at all the numbers on the T12. We break numbers down. We try not to miss anything when we're underwriting these deals. So we'll kind of go over both high level and maybe a little bit more detailed. And without further ado, Jeff, take it away and take us through this great presentation.
Yeah, absolutely, Gary. So one thing that I just want to mention, on top of what you said, Gary, is that, when I say high level, low level, and super high level and super up close level, is that because we look at so many deals, and if we go deep into the underwriting of every single deal, there's no way we're going to go through 10 plus deals a week. And the only way for us to do that is by looking at it using literally 5 or 10 minutes to see if the deal is a deal or not. Because guess what, with the low interest rate environment, 90 to 95% of deals out there is not worth spending more than 5 minutes. So the next slide, I'm going to go through how we look at deals using the 5-minute underwriting rule. So as you can see from this,
Jeff, real quick, your opinion, how long does it take you to do a very detailed underwriting when we go real deep in the numbers? How long does it take?
So if the deal makes the first cut, Garrett, and if we want to put up a somewhat, professional underwriting model together, I think that with the amount of research that we're going to do, which we're going to touch in a second, we need about somewhere between hour to hour and a half to do that underwriting.
For me, it takes about an hour, and it's a pretty detailed look, but I'd say on average, it's about an hour to deeply underwrite these deals. So if you're getting a bunch of these thrown at you in a week, there's not enough hours in the day sometimes. So hopefully this will be able to show people some quick ways of doing underwriting.
Absolutely. And I think the 3 levels that I'm going to share for a second is that there's a first layer, the second layer, and the third layer. What we talk about is the first layer is, as you can see from this slide, 5-minute underwriting. 5 minutes or less, we want to see if the deal is a deal or not. Then we go to the second layer, which is underwriting that Garrett and I just talked about. We spend about an hour and a half, dive deeper, looking at T12, looking at rent roll, which we can talk in a second. But if we really like a deal, or even possibly put in the contract, that's what I will call it the third layer. That's when we will open up every single financial statement that the seller provided. We're going to call up multiple insurance agents, call up the county assessor, and that can take us anywhere between 10 hours, 20 hours, 30 hours a minute to make sure that every single number that we put on our initial underwriting is accurate. And this is what I call the third layer. We're not going to talk about that today. We're mostly going to be talking about the first layer, the 5-minute underwriting, and also the second layer, which is about an hour underwriting to see if the deal is a deal.
Awesome.
Great. So this slides, you guys can see, is what we will call the first layer underwriting. Literally, you've got 10, 15 deals thrown to you every single day or even every single week. We look at what is the asking price per door, which you can easily obtain by talking to the broker, or sometimes it's written on the OM. So we take that number and then we use a few market research tool, which we're going to share in the next few slides. In terms of market rent per door, we want to make sure that the market rent, the future market rent, once we've done with all the renovation, will be at least equal to, if not greater than 1.3% of the per door purchase price. Hence, we call that the 1.3% ratio internally. So for example, the number you guys can see here, this is actually a live deal that we're looking at. The market rent is $1,000 a month. There are 20 units times 12 months. For the expense ratio, we typically use somewhere between 45 to 50%. And occupancy, we use 90%. And the market that we're looking at is a pretty strong market. So we use 6% as the exit cap rate. So within literally 1 minute on your iPhone, on your computer, you can calculate, given the amount of information you have, such as the market rent, such as the cap rate, hey, guess what? This deal is worth about $2 million or $99,000 per unit. So the number we share below is actually some real number that we're looking at. Purchase price, $70,000 a unit, maybe lower. The market rent is $1,000 a unit. You do the quick math, 1,000 divided by 70,000, that's 1.43% ratio, which meets the 1.3 minimum ratio that we're talking about. So this will be one of the deals that's worth us, guess what, taking another hour to do a deeper underwriting.
Absolutely. And this is a deal that we are currently looking at right now. So as of this recording, we are hoping to hopefully have this deal under contract within a week. So fingers crossed. So this is real life. Hey, Jeff, I know when I first started doing some initial underwriting and I was looking at houses and smaller multifamily stuff, you'd hear the 1% rule. This is similar, but why doesn't the 1% rule really work?
Absolutely. It's a great question, Garrett. 1% rule would work in certain markets with a low cap rate. However, one of the major difference between apartments and single family is that for single family, typically obviously depending on market, with some of the higher rent market, your per unit cost as a percentage of your revenue will usually be lower as a percentage than apartments. Therefore, you can afford to pay slightly more because all your biggest costs will be insurance and property tax and some repair and maintenance reserves. Versus in multifamily, you've got insurance, you've got taxes, repair maintenance reserves, you've got property management, and 10 other line items. Because of that, we like to buy a deal that has a little bit extra cushion to account for those expenses. That's my take on it.
Agreed. One thing I'll add, a lot of times the owners are paying the utilities, and utilities, the main ones are water and sewer. And that's a big line item in the expenses. A lot of times with single families, your tenants will be paying those. So 1% rule does not, in our opinion, doesn't really work for what we're looking for, which is cash flow.
Absolutely, 100%. So let's dive deeper. Once we look at the 30,000 feet level, let's dive deeper to a bit closer. So there are a few objectives that we'd like to accomplish on this webinar. The first one is we'd like to go through the 6 steps that we use and take you guys step by step how we underwrite a multifamily deal into simple to digest, easy to understand 6 steps. The second thing is we would like to point out 5 things to look for before you invest in other people's deal, because Excel spreadsheet can be pretty daunting, but out of all the inputs that a sponsor, a group put in, those 5 things that we'll talk about will really be the main game changer of how the return will look like. And we'll show you guys what are the 5 things that you and us should be looking at when we look at other people's deal to invest in.
Awesome.
So let's look at the first objective of this call, of this webinar, is what are the 6 steps to underwrite a multifamily deal. It includes research market demographics, research market rents, normalize operating expenses, determine CapEx amount, determine exit cap rate, market vacancy, annual rent growth, financing terms, The sixth step is pull it all together. So you can probably tell, Gary, from this sheet, when it comes to underwriting, I think most people's first impression is you can open up an Excel spreadsheet with 15 different tabs on it. But how I look at it is it's really 80% of the job is done through research, a lot of research, because the input that you put into your spreadsheet can only be as good as the amount of research you do. So for me, underwriting really is a process about research, and we're going to go through the steps that we took to do all this research. So step number one, research market demographics. The reason why we put this as a first slide is that everything could look great on paper. We can buy a property in downtown Detroit with the best cash flow with 15% cap rate. But guess what? The population has been decreasing every year by 2 to 3%. Home price has been going down. People are moving out. So that's probably not the market that we want to look at. Those are the few tools, Garrett, that we use to quickly determine what the market demographics are. Again, we'll break down into the macro level, the high level, and also we're going to show in the next slides the more closer up level. And for the micro level, we like to use this website called.
Sorry, real quick. So the reason, just for maybe some of our newer investors, the reason when it comes to apartment investing, and we're talking about, it should be, even if you're doing single family or small multifamily, but when you're buying 100-unit apartments, these things are important because this is what drives your rent growth. When people are moving to a particular city, there's a demand for housing, particularly rental housing. So these factors here, these demographics, this is what drives these increases in rent growth. It decreases your vacancy level, which is a killer to your bottom line. So just maybe for some newbies, wanted to explain a little more why these demographics are important when you're selecting a market.
Absolutely. So those are great points. And in the long term, you're going to see more appreciation because the cap rate will keep steady, if not going lower. And that's why Detroit, despite the cash flow, probably is not a market that excites us. So on a micro level, a few criteria that we would like to see, if possible, is that population. We want that to see grow by 20% or more. And this deal we're looking at, Garrett, I believe the population has gone up by about 48, 49% or more since the year 2000. That's why we're super excited for this deal. Median household, absolutely. Median household income will likely to be at or above $40,000 a family, or has grown by 30% or more. The reason why we pick $40,000 is because once you get below that level, called $35,000, $32,000, as the landlord, you will have a tough time to attract high quality enough tenant to be able to afford the rent. The delinquency will go up, so as many other factors. That's why I like to keep the income at or above $40,000. The median house value, we like to see it grow by 40% or more. And also, ideally, if you use Zillow or some other, research tool, we would like the market price of the condo or house nearby to be at least 1.5 times the amount of purchase price of the apartment. Because, once the house nearby is so cheap, chances are the tenant who's going to live in your apartment might want to buy their own home one day, which is great for them. It's an American dream. Everyone should encourage that. But as a landlord, you'll see a much higher turnover rate because of that.
Agreed. As owners, we don't want our we shouldn't say that. We do want our tenants to be able to live the American dream. But as an investment standpoint, if they can go and buy a single family home for about the same price as the unit, then it makes sense to go buy a single family home, and we don't want to see that.
Yep, absolutely. And the last one is crime rate. We do not want to buy a place where our property manager will feel very scared to go there at night to collect the rent. And we can easily identify what a crime rate looks like by going to this website, citydata.com. And in the next two slides here, we're going to go through two real examples. So for our people to go onto their website and do their research.
All right.
So the first example that I have is Tampa. Again, all you need to do is type in Tampa, Florida, citydata.com, and click on the first link, and then this page will show up. As you can see, population 2017, it is a few years like, but again, we're just looking super high level to get a general sense. It's grown by 27% since the year 2000, so check. Median household income, $50,000 per year, check. And that has grown, by roughly 50% since the year 2000. check. And the condo value is 233,000, which is a pretty healthy one, has gone up way above where they were in 2000. So just from this page, you can tell, you know what, it checked most of the boxes that we want. So let's dive deeper into the next one. So this is the crime rate the crime rate index. Again, it'll be at the bottom page of the citydata.com. So as you can tell from year 2005, because the murders, because the rapes they come up with this number 695, which is above the 500 that we talk about. But as you can tell, over the course of the next 15 years, it has gradually gone down year over year, which tells me that the city has done a great job in terms of keep the crime rate low. In year 2018, the latest one is below 200, which is pretty nice. So not only do you want to see that number to be at below 500, and ideally, you would like to see the trend to go down gradually as opposed to going up.
Awesome.
So let's use an opposite example. As we talked earlier, Detroit, Michigan, its population has gone down by about 30%. So almost 1/3 of the city people has left since the year 2000. And median home income, 30,000, pretty low, which has basically not changed since the year 2000. And home value is $50,000, super, super low. It's actually been gone down since the year 2000. So high level, with some very few exceptions, this probably is not a market that most of want to touch from multifamily perspective.
Yeah. Now we're not saying there's not deals in Detroit. I'm sure there's plenty of deals in Detroit. It's just Absolutely. What we are looking for, and a lot of multifamily investors are looking for, are some of these strong demographics. And I will add a little bit to this, Jeff. One thing that I've noticed in my time investing is that where you find these solid growth markets, for example, here we have Tampa, Phoenix, Dallas, Texas, these big growth markets. Just understand that this information is public. Anybody can find this. So with this information, I would say brings a lot of competition. So it's going to be hard to find good quality deals in some of these markets because everybody is looking in these markets. So just understand that. And I know I got a little frustrated at the beginning because I started, picking some markets because of these demographics. And when I got there, I realized, holy cow, it is hard to find deals that work because there are professionals that have been doing this for years and years and years in those markets. So with these solid demographics comes competition. Just be aware.
Absolutely. That's a great point, Garrett. So just very quickly, looking at the crime index, 1,000, it has gone down, but still 800, which tells us that, there's tons of crime going on in that market. Probably just want to be super careful if anyone wants to enter that market. So we talked about using city data to look at super high level. The next slides is we use this website called censusreporter.org to dive deeper, looking at block by block what the demographics look like. Because as we all know, real estate is super regional. It's not by the city. Even within the same city as Tampa, certain blocks might be much better than the other. That's why we like to use this website, censusreporter.org, to determine what's the poverty rate, what's the median household income, and what's the median home rate. So again, use Tampa as an example. Once you type in this website, it'll ask you to type in the address. Then you put in the address of the property that you're looking at. It'll give you different options from 1 block to 2 to the zip code, all the way up to, to the city. Usually we'll pick the first 3 to see how, because we want to be, narrowing enough so that the data is relevant for our property. But at the same time, we want to be wide enough so that there's enough data for it. So we typically pick the second or the third one, but you can play around with that. And this is the amount of map, the coverage area to show how much data is included. And this is the subject property, for example. And this, once you click on it, this will be the data that'll show you. So 41,000 median household income in that block, 22% poverty rate, a little bit high. But this is just an example to show that how you can, using demographics tool, free tool that everyone have access to look at super high level data on the city, but also much more in-depth data on the neighborhood of the property that you're looking at.
Great information.
So in summary, using city data for macro demographics and use censusreporter.org to look at the micro demographics to find out the home value, the household income, poverty rate, population growth, and all that good stuff. So we talked about the first step, which is research demographics. Right now, we're talking about what tools that we use to research market rent. Again, I like to look at things from super high level and also, down to earth. The high level one that we use is this website called rentalmeter.com. They do have a 7-day free trial for anyone to put in an email address. We do have a paid account, but that's a great tool to help decide on a high level what is the market rent is for 1-bedroom, 2-bedroom, 3-bedroom. However, since real estate is so asset specific, we use other websites such as apartments.com and a few others to decide whether the number provided by rental meter is accurate or not. So this is an example. Once you put in the property address here in rental meter, it'll show you the median rent for a 1-bedroom within a 1.5-mile radius with 19 comps is $864. For 2-bedroom is $1,100. 3-bedroom is $1,627. That'll give you some general idea, but we definitely would not put this number into our underwriting because this is too generic. We just want to have a super quick 5-second gauge to see what a market rent looks like. And another number, Gary, that we usually see is using this 25 percentile to 75 percentile number to see, okay, the bottom 25 percentile of the property can charge $941, and if the in-place rent that we're looking at is called $700, guess what? We're pretty confident we will be able to increase the rent. And vice versa, in the later slides, we'll talk about if you see a group that says, hey, we're going to increase our 2-bedroom rent to $1,400, you quickly use this side, hey, the top 10% rent only charges $1,277. And if you think that your property can charge $1,400, guess what? I think it's a bit too optimistic. So super quick way for us to see what a market rent looks like without spending more than 5 or 10 or 15 seconds to it.
Okay. And just to reiterate, this is the macro level, right? Because this is going to pull 2-bedroom houses that are rentals. This is going to pull, A-class properties versus C-class properties. So just remember that when you're looking on Retometer, that's macro look. We got to go into detail more, which Jeff will go into.
Absolutely. So to go to a little bit more in depth, apartments.com is a website I would like to use a lot. It has tons of good data on it. You put in the property address in this top left corner. It'll give you a lot of comps in the area, and it'll be your job to spend somewhere between 5 to 10 minutes, which in my opinion is one of the most important steps of the underwriting, to find comps that are similar, slightly inferior, similar, slightly superior to your property. And the reason why I mentioned slightly superior is because that'll give you an idea of, by spending X amount of CapEx, you can potentially increase your rent from where it is today to this, target property that you're trying to increase your rent to. So this is an example of one property that have the 1-bedroom rent in this range, 2-bedroom rent in that range, with the square footage, with the rent, 1-bedroom, 2-bedroom. If you think that this is a good comp for your property, then this will be a very good data for you to have for your underwriting purpose. Another thing that I would like to look at is also part of apartments.com. They've got features of the property, high-speed internet, dry and washer in unit, and how is that compared to the one that you're looking at? What's the vintage of the property, 1993? When was it renovated, 2019? What kind of outdoor space do they have? Are they gated? Do they have grill? Do they have picnic areas? So all of that stuff will play into a factor into how is your property stacking up against this property, who is your competitor, and all that is good information to have. So then what we like to do next is so this is a part of our underwriting sheet. The purple one is what we think the 1 to 2 and 3-bedroom rent will be for the future. And this will be the market comps. It's a little bit messy here. All the market comps we gathered from apartments.com. We like to write down what their amenities look like, how far they are from the property, what year they're built, and therefore determine, are they more superior, are they more inferior than our property, and then come up with your best guesstimate on what your rent can achieve. Again, there's never a correct answer until after you have bought a property, but by going through this process, it'll give you a pretty good idea within, I'll say 20, if you do it right, you should give you a pretty good estimate within $25 to $30, maybe $25 to $50 from the real number. So that's a process that we'll go through as part of our hour and a half underwriting process. So in summary, the second step, market rent research, we want to use rental meter to research the high level, market rent. Takes about less than 15 seconds. Then we use apartments.com to research the micro level. That process should take somewhere between 5 to 10 minutes.
Cool. Hey, Jeff, some other things we use CoStar sometimes. CoStar is a company that collects data, rental data, sales comp data. What we have noticed is that they're not always 100%. So people that only use CoStar, beware. The particular property we're looking at right now is a 20 unit and CoStar has it listed as a 30 unit. So you gotta trust but verify in these situations, but it's just another tool to gauge potential pro forma rents for our underwriting.
Absolutely. So we talked about market research, the demographics, we talked about market research to rent. And the third thing that we do in our underwriting process is to normalize the operating expenses. And there are a few jargons here. What the number one thing we look at is the operating expense ratio, which basically is dividing the operating expenses divided by the net revenue. Typically, in bigger complex, we see that ratio somewhere between 42 to 50%. But keep in mind that depending on the vintage of the property, depending on the size of the property, this can go higher and also this can go lower. For example, and also market rent is another determining factor. If the market rent in the area is $600, which is pretty low, guess what? It costs just about the same amount of money to replace a toilet in a market that charges $600 rent as a market that charges $1,500 rent. Guess what? If the market rent is lower, your expense ratio tend to go higher and vice versa. Operating expenses per unit. We typically see property running somewhere between $3,500 to $5,000 per unit, but it'll vary quite a bit depending on the tax and insurance, etc. Best way is for you to make a relationship with a local property manager and ask them, hey, how much does it cost for your company to run a property in this area with this vintage? The third thing that we'll look at is what is the operating expenses per square footage. So by having those three items in your toolbox, you can maybe not 100%, but you'll be within 85 to 90% accurate in terms of predicting what the future operating expenses will look like without spending too much time on the underwriting process. So we like to use an example from a real, OM, offering memorandum. What you typically like to see is, what is the T12 or trailing 3 months, T3 or trailing 3 months. Basically, it's all the data that comes from the last 3 months from the broker. We would usually assume that those numbers are accurate unless they prove us wrong. For the first initial hour underwriting, we don't dig too deep into it. We assume it's accurate, but as we go deeper, we're going to do more research. So this will be a good place to start. You're going to basically normalize how much they spend in the last 12 months and how is that going to translate your expenses, going forward once you acquire the property. And one thing that stands out, as you can tell, property tax before the acquisition is $36,000 and change. And the broker has correctly adjusted that to $80,000 because guess what? Once you buy the property at a much higher valuation, the property tax is going to go higher. And it looks like this is fits into one of our criteria, Garrett. The per door expenses before in place is $3,900. And afterwards they adjusted to $4,200.
Yes.
But again,
so I just want to touch on this. This is for maybe some of the new people looking at some of these deals. Brokers want to get deals done. They want to make the numbers look as good as possible. You have to go through this data and pull it apart, pick it apart. You can trust but verify. I tell you, in my opinion, I don't trust very often because most of these brokers, they just spit numbers out. There are some good ones that will get detailed with their numbers. But we'll look at the trailing 12 in this situation, but their pro forma, in this case, this one's pretty good, but we'll go and we'll make our own, year one pro forma. We cannot always trust the broker's numbers. All right, that's my numbers.
Absolutely. Yep. And as you dig deeper and deeper into the process, all those numbers will be refined 5 times, 10 times, 15 times if needed. If the deal's under contract, you're going to have your local property management team to verify every single line item, have them come up with a budget to update all those numbers. And as for the rent, you're going to do a lot of secret shopping to see how much your competitors charging and update those numbers, constantly as well. So this is a expense rule of thumb, just to give credit to David Tubin, who has an underwriting model that's also really good. So we use that again as a gauge to see how much the expenses should be running at. You guys can take a screenshot of this, which I think is really good. If it's below 70 unit, between 100, 200 units, above 200 units, in general, how much per door per year the apartment should be running at. Again, this should only be served as a guidance. It should not be used as your definitive underwriting final number. But again, we just want you to have a general sense of how much things should be running at by using this table. So this is our internal, one of the underwriting sheet that we use internally. We put down the T12 or the trailing 12 months data from the broker, and then we transport that into our own underwriting. And this process should take about somewhere between 15 to 20 minutes. So as you can tell, the T12 shows they are running at around $4,200 per door, but we think that because of a few reasons, we're going to be running at $5,000 per door. That's just one example of how we normalize the expenses from where it was before we make the purchase to where it is after we make the purchase. So the first, just as a quick recap, we talked about research market demographics. We talked about research market rents. And the third thing we talked about just now is research how to normalize the expenses. So I want to talk about quickly, the fourth step here is how to determine the CapEx or capital expenditure or renovation amount to help decide how much money you need to bring in order to improve the property to increase the rent. The best way to do that is by talking with your local property management company to rely on their expertise to determine that amount. And that should usually include both interior and exterior of the property. No matter how much we budget, we always go over the budget. That's why I like to put in a contingency here. Typically, I like to put in 10%, but anywhere that's 8% or higher would be a good starting point. A rule of thumb is that if the per unit renovation is under $5,000, we'll call that a light value add. You do some cosmetic, the paint, and some light upgrade. If it's between 5,000 to 10,000, that's medium. Anything above 15,000, that's a pretty heavy value add. Again, just super quick, high level rule of thumb. There's no right or wrong to that, but that's just how we use. In this project area that we're looking at, I think we're budgeting somewhere between 10 to 15 because the owner probably has not done any renovation for quite some time. So we'll consider this to be a probably medium-ish renovation. What would you say?
Yeah, I would agree. Yeah, I would. It's not light would be, cabinets are in good shape. Maybe we don't have to replace vanities. So it's really like lipstick, right? Paint, maybe paint the cabinets. Don't really got to worry about countertops. This particular property we're looking at right now, the market calls for granite countertops potentially or high-end finishes. So in order to get the rents that we're projecting, we're going to spend a little more money to get the high-end finishes, but it will return because of the fact that rents are so low in the market.
Yep, absolutely. And another thing, like Garrett said, is to determine how much capital is needed is by looking at your competitor, how much rent they're charging. If they're significantly higher than yours and their finish is significantly higher than yours, guess what? It might be worth having a contractor looking at those pictures that your competitor is doing and estimate how much it'll cost to renovate a kitchen, how much it'll cost to renovate a bathroom, etc. But one thing that we do want to avoid, and you also want to avoid, is what we call the over renovation. In certain markets, even if we put 24K gold in every single part of the apartments, guess what? The rent is not going to go up by that much. So we don't want to over renovate it. That's something that definitely be looking out for.
Agreed.
You know what? I probably have a little typo here. It's a step 5. It's determine the exit cap rate. Exit cap rate, market vacancy, annual growth, and financing terms. So those are a few things that does also play a role into your ultimate return matrix. So we're going to talk about that just a little bit. Exit cap rate. Cap rate has a pretty close correlation with what the interest rate is. As of this recording, we're at a pretty historic low interest rate environment, and interest rate might continue to stay low in the next foreseeable future. But once it rises, guess what? I think the cap rate will also rise as well. For that reason, when we buy the property, we underwrite the exit cap rate, we would usually like to increase the exit cap rate by 0.1%, or we call it 10 basis points each year for the holding period. For example, if the current market cap rate for Tampa market is 5.2%, we're going to be holding on it for 7 years. We would like to be conservative. We're assuming, hey, guess what? 7 years later, nobody knows what the interest rate environment will look like, but we're assuming that the exit cap rate will go up by 0.1% each year, or with the market exit cap rate of 5.9% for us to mitigate the potential rising interest rate environment.
I just want to add to this, Jeff, real quick, for maybe some people thinking about passively investing into somebody's apartment or offering. This number right here can drastically change the returns, cash on cash and IRR significantly. So make sure you do your research when you're looking at the deal and the offering, and make sure that the exit cap rate they're using is conservative. Just wanted to
Absolutely. Yep, I've seen some deals where the sponsor in a market that currently has about 5.2, 5.3% cap rate, their exit cap rate is 5%, and for the entire model, that's the only number that you see to know, guess what, this is way too aggressive.
No way.
So,
yeah,
absolutely. Annual rent growth, given where we are in the economic cycle, we like to be very conservative. We like to assume that in some cases, unless the rent is way below the market, we like to assume that there will be very little or zero rent growth for the next year and a half to 2 years. Typically, the rule of thumb is somewhere between 1 to 2 years. So you want to be careful how aggressive you want to have your rent growth be, because other than the exit cap rate, the rent growth is one of the biggest input that can dramatically impact your IRR. Any deal will look great if you put in 5 or 6 or 7% annual rent growth in there. Any terrible deal will look great once you put that. So be very careful of what kind of rent growth that you put in there. We typically will not put anything above 3%. Even 3% is on a more aggressive value. We like to be as conservative on this as possible as well. Financing terms. The best way to get the financing terms is by talking with your lender. A few big ticket items is what's the interest rate, how many years of amortization. Typically for bank loan is 25 years. For agency loan, Fannie Mae or Freddie Mac, it's 30 years. How long is the interest only period, which that will help your cash flow dramatically. What's the long term, meaning what's the balloon payment? How many years do you have to pay back the entire loan by either sell the property or doing a cash out refinance? Typically is somewhere between 5 years on the lower end, all the way up to 10 to 12 years with the agency debt. So those are the 5 or 6 items that you want to talk to your lenders about. This is just a quick example of the underwriting spreadsheet. Once you know the number, as you can see, you're going to put in your income increase, each year here, expense increase, how many years of the interest only. Once you know those numbers, really underwriting, Gary, I think it's really just putting the numbers. What's difficult is to get an accurate and also conservative information from talking to different parties. The underwriting part literally is just to putting the numbers that you have learned from different parties, which takes less than 10 minutes.
Agreed. So the first 4 or 5 topics they went over, which is the market analysis, the rent analysis, that stuff is the most important stuff. Underwriting's daunting when you first start, the numbers and how they work. But once you kind of get good at this, you're just plugging and playing these numbers. The quality of the sponsor or the operator comes from the quality of research that they do into the market and the data. And then they have to take that and be realistic and conservative on their spreadsheet. Because again, when we're offering these investment opportunities, it's really just somewhat speculation, but it is as good of speculative numbers that we can possibly get to, because we want to make sure that we are conservative with our investors' money and our money.
Absolutely. So in summary, again, sorry for typo, step 5, a few things to determine is what's the exit cap rate, market vacancy, annual growth, and financing terms. So the last step really is to put everything together, in a syndication that we do, or where you invest with the correct purchase price. Typically, the IRR will range from 16 to 19%. The cash on cash return will be somewhere between 8 to 11%. But on some of the heavier value add, it can go higher or can go lower. Last but not least, equity multiple, typically what I've seen as both a sponsor and also as an investor, is somewhere between 1.5 to 2 times. What that means is for every $100 that you put into a deal, once you account for all the cash flow that you receive each year, and also the profit that you make upon sale, your $100 should theoretically be turning to somewhere between $150 to $250.
And Jeff, that's in a given time period, right? So there's typically a time associated with that, correct, on these deals?
Yep. Absolutely. Typically, the deal is, the typical deal holding period is somewhere between 5 to 7 years. So you should expect your money to grow by somewhere between 1.5 to 2.5 times during that 5 to 7 years of holding period.
Awesome. Hey, Jeff, real quick, can you go back to that slide real quick? Explain to some of maybe our newer investors, what is IRR? What's an easy way to think about IRR? Internal rate of return.
Absolutely. So IRR stands for internal rate of return. Without getting to too details, think of it as a annual compound rate. It's not a simple return, it's a compounded return, which can be very powerful over the course of 5+ years. So a 16% IRR basically is assuming that for every $100 that you put into the deal, your money should theoretically grow by 16% each year, year over year. So the second year, it'll be 16% on top of your $100 plus the original $16. So basically ours internal rate of return, or think of it as the annual compound growth rate of your initial investment.
Awesome. That's great. It takes into account also the time value for money. That being said, the quicker that your capital is returned to you, the increase of that IRR. So that's also important, meaning that you can take that same money, go and put it into another investment, and it will earn some type of return. A lot of new investors, and I know I made this mistake at the beginning where I didn't know the difference between cash on cash and IRR, average annual return. So what you have to understand in these multifamily syndications, or these commercial assets that you're investing into, there's typically some type of liquidation event, anywhere between year 2 to year 7, sometimes longer. And what I mean by liquidation event, that's either a sale or a refinance. And hopefully the sponsor has executed their business plan, done a good job, gotten the rents where they said, added the value to the building. And when they sell or refinance, they get to return all of your capital typically, or a lot of it sometimes on a refinance. And then there's typically some upside. And so that IRR, or average annual return, takes that sale or liquidation event into account as well. So people will say, well, I invested $100,000 and in the first year I'm making $7,000. Well, that's your cash on cash return. It doesn't account for the future sale or refinance, and that IRR number does. So I just want to do a little clarification there for maybe some of our newer investors.
Yeah, absolutely. It's great clarification, Garrett, for sure. So again, this is a sheet where we put all the research that we've done together into one sheet. And the table looks complicated, but really, if you look at where it's highlighted in blue, that's really the only place where we'll do the input. And the rest of the parts in black is just really automatically, populates. If you look at this line item, cash on cash, as Garrett just mentioned, this deal is one of the deals to look at in the past. It'll have somewhere between 9% year 1 all the way to 11 to 12% of cash on cash return, meaning for every $100 that you put into the deal each year, you should be expecting to receive a distribution of roughly $9 and change. So as you can tell, this page probably have 100, 150 numbers, let's call it. And the real input that you need to put in really is less than, 10 numbers in there. So in summary, We talk about the 6 steps to do underwriting, market research, demographics, research market rent, normalize operating expenses, determine CapEx, determine exit cap rate, market vacancy, annual rent growth, financing terms, and the 6 steps where we see that as the underwriting really is really the last step. Once we've done all the research, underwriting basically is to put all these numbers together, which takes less than 10 minutes. So underwriting really is a research process. It's not a process to play around the Excel spreadsheet for an hour. It's really do your due diligence, do your research, go to the right market research website, talking to the right industry expert to get those numbers nailed down correctly. So we talk about the 6 steps to take to do a deal underwriting in an hour or less. I want to spend the second portion of this webinar to talk about the 5 things that we should be look for, or you should be look for before you invest in someone else's deals. Most of those variables we had talked about in the earlier presentation, but I want to point out those 5 factors because those 5 factors will play 80% plus have 80% plus impact of what the final return looks like. Number 1, as cap rate, like Garrett said, if you see a sponsor with an exit cap rate 5% or less, not to say that's not achievable, but it's definitely a red flag because in our opinion, it's probably too aggressive given where we are in the interest rate environment. Market rent, if the sponsor's rent estimate is at above 75% of what the rental meter says, again, it can be the nicest building in the market, Class A, brand new construction, but that is another sign that I'll be very careful of the deal that I'll be looking at. Rent growth, we talked about earlier. If the rent growth that's set is 4%, 5%, 6% per year, it can literally make any deal look the best deal on the planet. So be careful of that. CapEx per unit, if it's $5,000 a unit or below, and if it's a heavy lifting, guess what? I've seen a project, Garrett, actually in the Washington, D.C. market. It's a heavy lifting project, and the sponsor said that our CapEx per unit is $5,000, which is just not realistic. Lastly, expense ratio. I've seen some deals where the sponsor put expense ratio at 23, 24, 25%, which is essentially self-storage expense ratio. I shouldn't say there's no way, but it's highly unlikely that an apartment, especially class B and C, which is what we're buying, can be run on an expense ratio of 40% or less. So Garrett, so I think this is it.
Okay.
I can't touch the last slide. We're probably going to cut it off. So I think this is the end of our presentation. And, Garrett, do you have any last comments or questions?
No, Jeff, thank you so much, man. You're a wealth of knowledge. I appreciate your time. Hopefully we added some value to our followers, our friends, our family, our investors. We're hoping to do more of these in the near future. We appreciate it. If you please could subscribe to our YouTube channel, because we got a YouTube channel now. Like the video, tell your friends about us, contact us. If you're looking to reach out, you can reach any of us on our team. And you can go to our website at rizeequity.com. It's RIZE with a Z, R-I-Z-E. We appreciate your time. Thank you. And look forward to seeing you guys in the future.